money, 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 money. Crazy about my money. Money, 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 money. Crazy about my money.
For the first time since 2020, the Federal Reserve has cut interest rates. This wasn't surprising, but the 50 basis point cut was larger than many predicted. There was actually only a 45% probability of a 50 basis point rate cut the week before the meeting. This chart shows the latest market expectations for the Fed funds rate. But what does this mean for stocks, bonds, real estate, and commodities? Let's briefly take a look at each. Bonds are probably the most predictable asset class on the list. Rate cuts have historically translated into solid returns for bonds. It's really just basic math when it comes to bonds. If an investor owns a bond with a 5% yield and comparable bond yields fall to 3%, then that 5% yielding bond is more appealing to other investors. Thus, the bond price should appreciate. Assuming bonds don't default on their payments, then falling interest rates should translate into higher bond prices and attractive returns. A disclaimer though, not all bond yields will necessarily decline when rates decline, and not all bonds behave the same due to credit quality and the type of bond, whether it be government, corporate, mortgage-backed security, etc. Stock market performance, on the other hand, is a mixed bag after rate cuts. Stocks fell dramatically following the rate cuts of 2000 and 2008, but there are plenty of other examples where rate cuts didn't precede a dramatic decline. See 1980, 1984, 1989, and 1995. Regardless, it's important to remember that the Federal Reserve is cutting rates due to concern over a weaker economy. Inflation fears now appear to be in the rearview mirror, at least for now. And the Federal Reserve is focused on minimizing potential job losses and avoiding a deep recession. While stock investors may celebrate these rate cuts, there is a potential offset to the fact that the economy is slowing, and that isn't always a winning formula for stock investors. Add in the uncertainty of an upcoming election, and it's essentially a coin flip for stock prices. Commodities, on the other hand, tend to benefit from falling rates, all else equal, unless the economy weakens more rapidly or dramatically than expected. As rates decline, the US dollar should weaken, in theory at least, and a weaker US dollar tends to increase commodity prices in US dollar terms. In an extreme scenario, higher commodity prices could restoke the embers of inflation, but again, it's worth remembering that any benefit from rate cuts could be offset due to a slowing economy. If job losses rise and consumption declines, then commodity prices may weaken. Much like stocks, commodity prices are a bit of a coin flip following rate cuts. Real estate may be the most interesting asset class over the next year. Home prices remain high, as do mortgage rates, which has led to some of the worst housing affordability on record. Affordability should improve as mortgage rates decline and could actually lead to a flood of activity. Part of the reason for the continued price appreciation of residential real estate has been this extreme lack of supply. Few homeowners are willing to sell an existing home with a 3-ish% mortgage in exchange for a new home with a 6-ish% mortgage. This dramatic rise in interest rates from 2022 to 2023 effectively trapped homeowners for the last 2+ years. As indicated by this chart, recent home sales are less than the COVID low point and rival the depths of the 2008-2009 Great Recession, which was actually caused by a bubble in real estate. Many looking to buy and sell real estate are simply waiting for rates to come down further. After all, why lock in a 6% mortgage now if we believe that rates are expected to go lower a year from now? We do expect a notable uptick in activity as mortgage rates decline. On the surface, this is a good thing. Lower rates equals more affordable housing. But it could also mean that housing supply will actually outpace demand as these trapped homeowners look for a change of scenery. If rates fall too quickly, it could even lead to a supply glut and eventually softer home prices and longer wait times for sellers due to the increased inventory on the market. Admittedly, we are miles away from that scenario, and it feels rather unlikely that that might play out over the next year. Barring a recession that crushes demand or a sudden supply glut, real estate transactions and prices should benefit from lower rates. It will take a little time before the current real estate market is considered a buyer's market, but lower rates are likely the first step in that equation. As always, we appreciate any feedback, questions, or concerns. We will make changes and suggestions as needed to navigate these challenging and interesting times. Thank you so much for your continued confidence and trust that you place in us. I promise we don't take it for granted. Thanks so much.
Money, money, money. Money, money, money. Crazy about my money.